Florida has 3 different types of state taxes, and I highly recommend you get a sheet of paper and write these out as we progress, because the math problems, especially the inclusive ones for this, get really, really complex. The first one is the documentary stamp tax on the deed. That's 70 cents per $100 increment on the full purchase price of the property. The next one is documentary stamp tax on the note, which is 35 cents per $100 increment on the amount of all new and assumed mortgage notes. That's new and assumed. And then the intangible tax is only on new mortgages. This one is 2 mils or 0.002 cents per $1 of the loan amount. And this one only applies to new mortgages. So if a mortgage is new, it gets tagged twice, once with the 35 cents and then a second time with the 0.002. I have a lot of students that make that mistake. First up is the state tax on the deed. Now the rate for the state of Florida is 70 cents per $100 increment on the purchase price, or 60 cents per $100 if you live in Miami-Dade County. And this is a one-time tax paid on the purchase price of the property. Just think of it as sales tax on the property. Now let's see it in the numbers. If a home sells for $71,200, the doc stamp tax on the deed will be $71,200 divided by 100. That tells us there's 712 stamps that you have to pay for. If the stamps cost 70 cents each, well, you just multiply them to get $498.40 as the doc stamp tax on the deed. Difficult part number 1 is remembering divide by 100 and then what to multiply by. The second part most students make a mistake on is not rounding properly if something is left after you divide. So here's an example. If any portion remains after dividing the purchase price by $100, you still charge a full 70 cents on the fractional part. So instead, let's say that property sold for $20 more, $71,220. Well, if you divide that by 100, you now have 712.2. Now the state's going to be greedy. They're going to charge a full 70 cents on that 0.2 or $20, even though it's not a full 100. They're not going to prorate it either, so it's still the full 70 cents regardless. So what you have to do is round up. 712.2 becomes 713. Then you'll multiply that number by 70 cents, and there's your answer, $499.10. So it's very important that you do not use normal rounding rules here. Any fractional part remains, round up to the next whole number, period. The second tax required by the state is on all executed and written promises to pay. Now, one key is to remember that all mortgages are accompanied by a promissory note. That's another part of the main course that you will take. All mortgages are accompanied by notes. So when they ask for the stamp tax on a note, they're really just talking about the mortgage. Now this tax is 35 cents per $100 or fraction thereof. This is a one-time tax paid on new notes and the unpaid balance of an assumed note. So let's look at the numbers. If a home sold for $90,000 and the buyer paid $10,000 in cash, assumed a recorded mortgage of $55,000 and created a new second mortgage in the amount of $25,000. The documentary stamp tax on the notes resulting from this transaction would be, we take the first mortgage of $55,000, divide it by 100, that gives us 550 stamps, times 35 cents per stamp, gives us $192.50. Now we're going to ignore how much the home sold for and the $10,000 cash down. We don't tax those. Well, the home selling for $90,000 we do, but it didn't ask for the deed, it just asked for the notes. Are there any other mortgages here? We have the $25,000 second mortgage. So we'll take 25,000, divide it by 100 to get 250 stamps for this mortgage, times 35 cents gives us $87.50 tax on the new note. And then of course we can add the two together to find the total taxes we're paying, which would be $280 between both of the notes. Now the third and final state tax that we have to worry about is on new mortgages only. The state requires payment of an intangible tax before a mortgage is recorded, regardless of when the mortgage was signed. Now because this is a one-time tax, it does not apply to assumed or previously recorded mortgages, just the new ones. And as we said before, the tax rate here is 2 mils or 0.002 per dollar. Let's look at it in the numbers. So a buyer purchased a property by assuming an existing loan of $62,350 and signed a new mortgage and note for $110,000. What's the cost of the state intangible tax? Now the important part of the intangible tax is they only go against the new mortgages. So the only new one that they signed into was the $110,000. Now this one, there's no dividing by 100, it's just a flat multiplication. So 110,000 times 0.002 brings you to $220 for the intangible tax.